Yesterday, we were extremely close to buying Adobe. The stock is down roughly 50% from its peak. The valuation looks compelling. At first glance, it practically screams buy. But just before pulling the trigger, we identified three issues, three very real deal breakers that made us stop and wait. So today's question is simple. Is Adobe the best value opportunity in the market right now, or is it a value trap? Today, we'll walk you through why we really wanted to buy Adobe and then the three reasons why we didn't. This is a Smart Wealth Code, your compounding machine. The bull case, why Adobe looks cheap. At the time of recording, Adobe is trading at $346 per share. The stock is down roughly 50% from its pandemic peak, and almost everyone agrees on one thing. Adobe looks cheap. Over the last 5 years, Adobe stock is down about 30%, and based purely on valuation, we've reached a strong conclusion. This is one of the best risk-reward setups in the entire market. Arguably, the best risk-reward in big tech right now. Adobe is cheap, Adobe is still growing, and many investors are calling it ridiculously undervalued. Even some analysts are outright recommending Adobe as a buy. At first glance, we agree. Using our preferred metric, price to 5-year forward earnings power, Adobe is trading at just 12. That puts it firmly in the undervalued stocks category, like Novo Nordisk. Don't worry, we are not going to drag you through 20 minutes of complex calculations. Take our word for it. The valuation is attractive. This is not a sell your house and go all in kind of cheap, but it is meaningfully undervalued. Is AI killing Adobe? Before we get to the risks, let's talk sentiment. Investor sentiment around Adobe is extremely negative. The dominant narrative is that AI is destroying Adobe's business and that tools like Canva are making Adobe obsolete. We don't buy that story. The fundamentals tell a completely different picture. Revenue is up, free cash flow is up, operating margins remain extremely stable at 36%. Does that look like a company that's being destroyed by AI? We don't think so. Professionals still rely on Adobe. I've spoken with multiple designer friends. None of them are replacing Adobe with Canva or AI tools. I even asked Reddit, has anyone actually ditched Photoshop for Canva or AI? The top answer was no. The point is this, sentiment around Adobe is extremely negative, based on a story that isn't showing up in the data. And that kind of disconnect is usually bullish. But now, we need to talk about the risks. Risk number one, the moat is leaking low valuation alone tells us nothing about future risk. While AI isn't hurting Adobe's revenue today, that doesn't mean it won't hurt it tomorrow. Let's be honest, Adobe's moat is getting weaker. 5 years ago, if you wanted to edit an image, create a thumbnail, or design a logo, you had one real option, Adobe. That's no longer true. In my last video, I created an image using Gemini and designed my thumbnail in Canva. And yes, I'm still an Adobe customer. I'm still paying for their tools, but I'm using them less and less, and I'm actively thinking about canceling. That tells you something. Adobe is becoming less of a necessity. Risk number two, the efficiency trap. Adobe is integrating AI everywhere. From a user perspective, that's fantastic. Tasks that once took 3 hours now take 3 seconds. But here's the problem. Adobe's business model is built on seats. If Apple hires 100 designers, they need 100 Adobe subscriptions. But if AI makes designers 10 times more productive, Apple may only need 10 or 20 designers. Fewer designers means fewer seats. Fewer seats means less revenue. Adobe is effectively selling tools that allow customers to buy less of Adobe. Management understands this risk, so they're pivoting to a hybrid model. They still charge for seats, but now they also charge for AI credits. Every AI action costs extra. The issue for investors is uncertainty. Will this new model be as profitable as the old one? What will the margins look like? How dependent will Adobe become on partners like Google or OpenAI? Right now, we don't have clear answers. Risk number three, people hate Adobe. This one is big. We already established that professionals still need Adobe, but customers absolutely hate the company. Creative Cloud now costs over 1,000 euros per year per user, and people are furious. Yes, customers complain when prices go up. Netflix raises prices, Spotify raises prices, but people usually stay because they still feel they're getting value. Adobe is different. Customers actively want to quit. People describe Adobe as evil. They feel trapped. Just look at Reddit. Adobe jacked up prices again. We need a real alternative. They're extorting a professional monopoly. That post alone has 1.2 thousand upvotes. Do you really want to invest in a company that makes its customers feel extorted? It's not our first choice. Our verdict, fair value and buy price. That said, we will buy almost anything at the right price. Our estimated fair value for Adobe is $440 per share, but given the risks we just discussed, we demand a large margin of safety. Here's the plan. We are waiting for one more major sell-off. Maybe investors panic over AI integration costs. Maybe they dislike guidance in the upcoming earnings report. Maybe the market reacts negatively to the cost of the Figma acquisition. If Adobe drops below $300 or ideally below $280, we will buy. At those levels, the stock is trading at 2019 prices. At that point, the upside becomes too attractive to ignore. Until then, we are staying on the sidelines. Thanks for watching.